How's it going, everyone? Welcome back to the Invest in Wealth channel. Today's video, we're going to be taking a look at my top picks for the best Canadian dividend stocks here in Canada. The Canadian market is still very down on the year. There is some absolute great buys out there. You guys really enjoyed my other video I made on my other dividend stock picks. So I thought, why not? I'll give you guys my other picks here. And without further ado, let's just hop right into my first stock. Jumping right in, first company we're going to look at is Royal Bank of Canada, ticker symbol RY. Right now it is trading at 113.65. As you guys all know, Royal Bank is the largest company in Canada and the largest bank in Canada, of course. So as you guys know already, the Canadian financial sector has been selling off very hard in the past year here. Most of the banks are pushing their 52-week lows. Over the past 5 days here, RBC is down 2.3%. The last month, they are down 7.12%. Last 6 months, they are down a whopping 15.62%. Over the last year, they are down about 8%. And over the last 5 years, they are up just under 15%. So Royal Bank, taking a look at their dividend yield, it is a nice 4.75%. 52-week high is 140, and their 52-week low is 111.50. So RY is nearing its 52-week low here, like most bank stocks here in Canada are. So I do feel like there is still a little bit more room to go down, but when interest rates do start to rise, you are going to see the financial sector have a big bounce back. And I do see Royal Bank having the most growth in the long term. We're going to take a look at the comparison to Royal Bank's peers, kind of see the past performance and kind of the similarities the stock prices have, and which bank stock has actually outperformed the others in the past years. Taking a look at Royal Bank compared to its peers here, we do have the top 5 largest banks in Canada. So over the 1 month, Royal Bank is kind of following the same trend as the other banks there. TD Bank is having the best month, only down 3%. But looking at the last 6 months here, Royal Bank has actually dropped the most in the last 6 months. So I do think that Royal Bank is the most on sale bank stock right now. Why I say that is taking a look over the last 5 years, RBC has just crushed its peers. They are up about 14.8% in the last 5 years. I do see this trend going to keep on continuing kind of the way it is. I do see Royal Bank outperforming the other banks going forward as well. So going back to the 6-month chart here. So I would want to buy RBC when it is on the most kind of on the best value of all the other Canadian bank stocks. So I do think right now is probably the best time to scoop up some Royal Bank shares, just because in the long run, it will probably outperform all the other big 4 banks in Canada. Plus, you're getting that nice 4.75% yield. I know that it is not as big as Bank of Nova Scotia's yield, but over the long term, I do think that growth will definitely outweigh the dividends. As you can see here, over the last 5 years, Bank of Nova Scotia down about 17.5%, and Royal Bank up 14.8%. So even though Bank of Nova Scotia is paying like a 7% yield, Royal Bank will definitely make up for that in the growth. Next stock we're going to look at is Fortis, ticker symbol FTS. Today it trades at 54.27. This is in the utilities sector, which is probably one of the most on sale sectors right now in the markets, due to the fact that they do have higher debts. So it is a big high interest rate environment right now. So the utilities sector is hurting quite a bit here, but that just means that there is some extreme value. You're going to be buying these stocks on sale. So let's take a look at their dividend yield. It is a nice 4.35%. So Fortis is actually going to be crowned a dividend king in Q4, which will mark its 50th consecutive year of dividend increases. And that is what dividend investors want. They want a nice stable dividend that grows consistently year after year after year. So taking a look at Fortis, their 52-week range is from about $50 to $62. So it's not quite at a 52-week low, but I do still think it is a fantastic time to buy. Taking a look at the 1 month, they are down about 1.3%. The last 6 months, they are down 10%. Over the last year, they are actually green. They're up 5.65%. And then over the last 5 years, they are up 27.4%. So Fortis, I definitely think that they will be hitting over the $65 range. Utilities are very volatile when interest rates are high. So I do think, like most of these stocks on the list, when interest rates start to go up, utilities are going to be the first to spike, followed by the telecoms and then the financials. So this is definitely a place you want to be at, even if you're just going to be trading this or holding for the long term. Fortis is definitely a stock that you're going to want to research. I do think there is some great value here. And like I was saying before, you're getting quality dividend income. So 50 years of consecutive dividend raises, not just 50 years paying out, 50 years of raising their dividend annually. Next up on our list, we have Allied Properties REIT, ticker symbol AP.UN. So this is a REIT. As you guys are probably aware, the REIT sector has gotten absolutely crushed this year due to the fact of the high interest rate environments, because the REIT sector they have a lot of debt on their books. And of course, debt is getting more expensive, so profits are starting to go down. But there is some massive value. If you wanted to get into REITs, now is definitely the best time to be buying. So this is a REIT that I have picked here, Allied Properties. Over the last week, they're about even. The last month, they are down 15.75%. Last 3 months, they are down about 21.35%. And then over the last year, they are down 36.65%. Looking at their 5-year chart, this thing has sold off very heavily from its previous COVID highs. Allied Properties was a $60 stock back in February of 2020. This stock has not been this low since the 2008 financial crash. I do believe that REITs are going to have a very sharp spike in their price. Hopefully in the next year, when interest rates do start to go up, you're going to see REITs bounce back by quite a large amount. I do think this will easily be a $30 stock again, probably in the next year, if not 6 to 9 months here. But this is my favorite REIT. Taking a look at their data here, market cap of about 2.3 billion. This is also a monthly paying stock. So those of you who do like the monthly income, this is perfect for you. They are paying a 10.19% dividend yield, which is huge. In my opinion, I do feel this dividend yield is safe. A lot of other REITs have cut their dividend. I don't think that's the case with Allied Properties. They're sitting on some cash. They have just sold one of their properties. But so Allied Properties they're mainly in the urban office space sector, mainly from Toronto and Montreal. Taking a look at about the company here. So their tenants include IT, banking, government, marketing, telecom firms. So these are very good tenants for the office space here. And like I said before, most of their square footage is located in Toronto and Montreal, which is a very volatile industry for real estate. But I do feel like there is tons of room to grow. Taking a look at the 10-year chart, this is at well under their 10-year low here. So I am going to be buying up some more Allied Properties just because I don't think REITs are going to be this low for too much longer. Like I said previously, once the rates do start going back up, the REIT sector is going to spike. So I do feel now is a very, very good time to buy some REITs. If you were kind of on the fence, I would hop in, do some research. Allied Properties is just my favorite company here, but there is lots of other Canadian choices as well. We do have a 3-in-1 here. This will be our insurance play for the pick. So I personally own Great-West Life. Their dividend yield is 5.32%. I've done very well on my position here. I do like Sun Life and Manulife as well. I do really like the insurance plays when interest rates are high. They are doing very well this last year here. We're going to go through the comparison right away here. But my personal pick is Great-West Life. I might pick up some Manulife or Sun Life. It's really just a coin toss, but let's go ahead and look at how they have done in the last month here. So in the last month, we have Great-West Life down 4.71, Sun Life down 2.76, Manulife down 5.65. So Sun Life is the winner on the 1 month. Let's look at the last 6 months here. So in the last 6 months, Great-West Life up about 4%, Sun Life up 1.3%, and Manulife down 5.2%. So Sun Life the winner on the 6 months. And then on the 1 year, we have Great-West Life up a whopping 31.24%, Sun Life up 17.32%, Manulife is up 13.36%. And then taking a look at the 5 year, Sun Life is a winner here, but Great-West Life up 30.63%, Sun Life up 33.75%, and Manulife up 19.18%. So Great-West Life, they are in the middle with their dividend yield. Sun Life is paying the lowest at 4.55, and then Manulife has the highest yield at 5.87. So if you guys are just looking for the income, I suggest you go with Manulife, as well as Manulife is on probably the best value. Just looking at the 1 month chart, their share price has dropped a little bit more than their peers, but I do like having some insurance in my portfolio. Great for the dividend, plus great for growth. I think when I bought Great-West Life, their dividend was around 7 or 8%. So I've done very well in this position. In the future, I might look to own its peers, Manulife or either Sun Life, but do your own research and pick which one is the best for your portfolio. But I'm sure you will do well in whichever one you pick. And the last pick on our list, but definitely not the least, we have Power Corporation of Canada, ticker symbol POW. So Power Corporation of Canada, if you guys didn't know, I'm sure you are familiar with the platform Wealthsimple Trade. So they actually own Wealthsimple Trade, which is really cool. I didn't know this just until recently, but this company is very interesting, and they also pay a nice high dividend yield of 6.1%. Their 52-week range, 31.47 for the low and about 39 for the high. Right now trades at 34.44. On the month, they are down 10%. Over the last 6 months, they are down 3.42%. Over the last year, they are up 6.79%. And over the last 5 years, they are up 25.79%. So I would classify this as a dividend growth company. I would maybe even put this in the category as a fintech stock, kind of, with their business in Wealthsimple. But just a little bit about the company here. So Power Corp of Canada is a management and holding company that focuses on financial services in North America, Europe, and Asia. Its core holdings are insurance, retirement, wealth management, and investment management, including a portfolio of alternate investment platforms. So they are in a ton of different business segments, as well as they're not just in North America. They're in Europe and Asia, and I'm sure that they're going to expand to other parts of the globe as well. But I do really like this stock here. I think it's a great buy. Good for growth and great for dividends as well. This is a quarterly paying dividend stock. But yeah, I don't own this yet, but I've always contemplated starting a position in Power Corp of Canada, just because I think they're going to do fantastic in the business of Wealthsimple. It is a fairly new platform, and they're always making improvements. I use it myself. There's actually a link in the description. If you guys want to sign up, you can win up to $3,000 in free stock if you use that code below. But yeah, it's a fairly new platform. They're always making improvements on it. I use it. I love it. There's no fees. I think they're going to do very well with that side in the Wealthsimple Trade and also in their managed portfolios. So this was my last pick, Power Corp of Canada. That's going to do it for this video. Hopefully you guys learned something new. And just remember, always do your research before buying up any stock. Just because I like the stock doesn't mean that it'll fit within your investment portfolio, but definitely do your own research. I really appreciate you guys watching this video. You guys enjoyed the last one so much. If you like this one, make sure you like and subscribe, and I'll see you in the next video. Thanks. Bye.